Why is everybody quitting real estate investing? You've seen me have this conversation with single family home investors over the last couple of days, but I wanted to go back and talk multifamily. Jonathan Twomley, obviously somebody who plays in a big, much bigger game than I do. And I'm curious, is everybody quitting multifamily investing? Jonathan, what's going on?
A lot of people have quit multifamily investing. That's absolutely the truth. So just like with single family, we've seen a big exodus. I've seen a lot of people who used to be like multifamily capital raisers now raising for like oil and gas deals. And like,
I saw that. I saw that.
Like there's a lot. Oil and gas seems to be the flavor of the month. You know,
Yeah.
they went through ATM machines, which turned out to be a giant Ponzi scheme. They have gone through a bunch of other things, but what I'm seeing now, oil and gas seems to be the thing that people are. So anyway, yes, they have left the multifamily space.
So again, I want to pull on that string because I think there's a lot of people that have left and been injured in the multifamily space. So we'll just talk about capital raisers first, right? But these would typically be called GPs, general partners, and not, one of the things that should be said is obviously it's very hard. It's much harder to raise money today than it was 3 years ago. And one of the things I think we're gonna see as a consistent theme is the easy money's gone, and thus all the what I'm calling the pretenders and the grifters are gone, right? It's only the solid operators that stay. And frankly, I'm happy to see the pretenders and grifters go because I don't think it's good for the industry.
So and this is just, do you remember it's been a couple of years ago now that we did my market psychology episode, and you guys should, and that's like psychology, like a cycle. So it's CYCH. So go look at that video. It explains when different people come into the market, but it's really like the people, the easy money folks, the grifters, the scammers, they're all in at the top because you've had this long period of time where everybody has made easy money. All you had to do is be in the market. All discipline goes out the window. People just really just start thinking like, hey, it's like basically free money.
Real estate only goes up.
Real estate only goes up. And in the especially in the last cycle, I mean, I don't think we had seen the acceleration of it going up, not in multifamily anyway. I mean, before the financial crisis, we saw that with single family, with just like the acceleration of people who could get in and get out, they could get in and get out fast without any effort and make a lot of money. And that just draws more people in. And so, FOMO starts to be a real thing. And once the FOMO phase of the market kicks in, that's when all the grifters and the scammers and the Ponzi schemes all come in, because it's very easy to grift when no one's really skeptical about anything. Now we've swung to the opposite pole where everybody's skeptical about everything. And it's very hard to raise money even for good deals because so many people have been burned or they've seen other people get burned. But because of that, it means that there is opportunity out there if you're willing to look for it, if you're willing to turn over a bunch of rocks.
That's the key to all of this. Again, like I said in some single family videos, and I'll say here again, I hated the part of the cycle where the grifters and the pretenders were winning. I mean, you and I've talked about a session in San Jose where I was speaking, where I was the old tired single family guy, and then there was somebody pitching syndications in Ohio. Never invested, never lived there, didn't know anything, but the guy raised millions and millions of dollars. Right? That's the part of the cycle I hate because all discipline goes out the window. It just sucks in all the newbies. And the problem with all the newbies coming in is they're going to bust out, lose everything, and never come back to the greatest wealth building platform out there, which is real estate. And it was just because they got in on the wrong part of the cycle, right? They didn't realize that was the most risky part of the cycle.
But so there's a couple of important things to understand. One is that they always come in at that part of the cycle, right?
True. And
the other thing to recognize, and again, go back to that market psychology video that we did a couple of years ago. It's the perception of the average investor, whether it's real estate, stocks, it doesn't really matter what the asset is. the perception of the average investor is that risk is lowest precisely when risk is highest.
Agreed.
And vice versa. And their perception of risk is like right now, real estate investors are spooked because they think, oh my God, real estate's so risky, when in fact, the air has been let out of the balloon, and it is a much safer proposition now than it was 3 years ago when they were all piling in like real estate was going out of style, right? So it's always that way. And that's the thing. If you have a long view of this market and you want to be a real estate investor for the long run, one of the most important things to understand is this market psychology. I really recommend a book by Howard Marks called Mastering the Market Cycle. If you have never read that, but it is all about psychology. It is not as a lot of people perceive. It took me a long time to read that book. I had it on my shelf for a long time. And the reason I didn't read it for such a long time is because I had people in my old Facebook group who were citing that book, who clearly, I didn't know they hadn't read it, but clearly hadn't read it, citing it for crazy stuff like, oh, there's this like 24-year debt cycle, and there won't be a crash, and because we're only 18 years into it right now, and that's what Howard Marks says. And Howard Marks says nothing of the kind. Like it does not even mention anything like this, right? So I had bought the book, but then I didn't read it because I was like, oh, this is BS. And then one day I picked it off my shelf and I was like, oh my God, this is like the same stuff that I've been thinking on my own for the last 5 years, right? So, but really read that book. And so if you're sorry, just to finish the thought, like, so if you are a long-term investor, you have to really understand sort of where you are in the psychological cycle of real estate, right? And if everybody around you is saying it's a bad idea, you can't make money, it's too hard, it's too whatever, that's when you should really be doubling down and looking for deals. And when everybody's jumping in, that's when you should be just selling like everything you got. Like just
I agree.
Oh, you want to pay me double what I paid for it 6 months ago? Yeah, it's all yours.
It's yours. Exactly.
Yeah.
This is the second cycle I've been through. And again, one of the reasons I continually go speak at events is I want to see where the masses are going. Because again, if you're paying attention, the masses will tell you where the risk is.
Oh yeah.
And they did again. And again, it happened in single family too, right? All these short-term STRs, and then all this, when they were just renting property, arbitrage, they were calling it. It was just like all this stuff is just piling on and is deemed easy money, and it's not. So the fact that the pretenders and grifters left means only the operators are left. And this is when we make money.
Yes.
Right?
Yeah. And you can do this with markets too, like not just like an asset class. And like, so for example, I've always been wary of Texas as a market to invest in, precisely because everybody was flocking to Texas. And that just made me anxious, right? Because it was like, if everybody's flocking there, I know that, it's going to be hard to find deals for the right price. And those kinds of manias always end. And plus with real estate, it attracts development, right? So like, and the real estate cycle, if you want to learn about that itself, is basically the development cycle. And, so when you start pulling in all that development, that means you're going to reach an unfavorable supply demand situation. And that's going to cause the market to crash. And like, that's just the way the cycle works. So it's much better to find like some kind of like market that's like nobody's really paying attention to, that's solid and steady Eddie and doesn't have those kinds of dynamics to it, than it is like rushing to the same place that everybody else is rushing.
No, I couldn't agree more. And again, the part of the cycle, again, I want to stress pretenders and grifters are gone, which means operators are left. But again, this cycle will take a while because I'm seeing more and more opportunities out there that quote unquote have hair on them, right? These are the first deals that come out. There will be others, but this is the time where operators get disciplined. They dig in, they write disrespectful offers. They write deals that make sense today. They don't write on some future bullshit appreciation. It's like, no, how's this stuff performing today? And it's that part of the cycle where real wealth is made. And also I've been talking about this for years. It's coming. The opportunity of a lifetime, perhaps, to pick up some small multifamilies from grifters who lost them to banks. So, right. The opportunity is coming right when everybody's afraid. This is when the opportunity is greatest.
Yeah. And it feels hard, right? But that's just because it's compared to the way it was a couple of years ago,
Yeah.
when really all you had to do was buy a deal. And I would never advise this of anybody, but like all you had to do was buy a property and it would go up and you would make money if you got out in time. And so, but that's not how real estate investing works, right? And so for going back to something you said a couple of minutes ago, I hated that part of the cycle too, because as a disciplined investor, it became almost impossible to buy anything because nothing made sense. And meanwhile, you're being told by everybody, you're a fool for being on the sidelines. Look how much money we're making. And I'm going, I don't understand how, like, I get that the market is zooming up, but this is not, that's just you're just making a bet. You might as well be betting. You might as well just be buying Bitcoin and hoping it goes up. This is not like real estate investing. It's, so it's very difficult as a disciplined investor in that environment. But for now, it's a lot, it's more like a normal market. Like it's always hard to find good deals, right? It's finding good deals
exactly. It's always hard. Yeah.
Right.
That's why operators are going to win. Yes.
Yeah. And what I'm seeing now, like we had a good discussion in my my school group on Tuesday that there are a couple of people saying, nothing's penciling. I'm looking for multifamily deals and nothing's penciling out. And I said, look, your run-of-the-mill multifamily deal is not penciling out right now because asking prices are just too high. They still have not adjusted to the market. And with debt, where debt is and where expenses have gone, like they don't make sense. But here's the thing. There are deals that do make sense out there and you just have to find them. And those are the deals that take a little bit of elbow grease. Right. Correct. So like one of my students was like, oh yeah, we just closed on 18 unit SFR portfolio. Oh, nice. But that was like, it took a lot of work because I had to, we had to underwrite every single property separately. It's 18 single family homes. So we had to look, we look at like 60 comps to get, it's like, there's a lot of work involved. And it's not like just underwriting one multifamily deal. Right. And it's all easy. It's like, it's work. Or when I'm doing hotel deals, I mean, these deals involve big, heavy lift renovation, right? But we know the value is there because we do the market analysis, right? We understand what the intrinsic value is of the asset, and we know what we can spend to get it where it needs to be, and what we can't spend, right? And that's where my friend Bruce Frazier, who has his business is completely independent of the market. It does not matter where the market is because he buys these buildings that are like 50% occupied, right? And he goes in and he rehabs them. And he's turning down deals from banks because they bring him stuff because he's got a reputation now for doing these deals and turning them around. Banks, he's like the first phone call that banks make when they get handed the keys to some syndicator who thought real estate was easy and let their property go to 50% occupancy, and they hand the keys back to the bank. And this happens at the top of the market too. It happens at every single point in the market cycle. And it doesn't matter, economy's good, economy's bad. Like, let's just say the market occupancy drops to like 75%, right? Let me say there's enormous distress across the whole market, but you pick it up at 50% occupancy. Well, you're going to make money by bringing it up to 75 to the market. And you know that in the future, absorption is going to take it back to your standard, like 90 to 95% occupancy. It doesn't matter what's going on with interest rates, with the economy, anything in that situation, if you're buying cheap enough. And that's why they say you make your money on the buy, right? At the height of the market, everybody poo-pooed that idea. You don't make your money on the buy. They were like, you make your money by like asset management. You make your money by like, financial arbitrage, financial engineering, all this kind of stuff. No. Well, all those people are now like sucking wind, handing properties back to the bank, having really unpleasant conversations with their investors about why they lost all their money. That's what's happening with those people who bought that stuff.
Yeah, the last thing I'll say about this part of the cycle and then why everybody's quitting is this access to capital is much harder, right? In the single family space back in 06 or back in 8 to 10, you only could get 4 loans. They wouldn't have investors get loans. today, all the LP money, not all of it, but a lot of it's dried up. Also, banks a lot more restrictive. But again, that is a good thing to me, because why? To your last point, I make my money when I buy. And if I have less access to capital, it means I have to pay less.
Yeah, exactly.
and this is why being a buyer, or what I'll call an operator, in this part of the cycle is a lot of fun.
Yeah,
because again, you make your money when you buy.
Exactly. And if you're a syndicator, listen, there's opportunity there too, because, a lot of people lost money in the crash, right? But there are a lot of people out there who didn't lose money in the crash because they weren't invested, or they were smart and they didn't invest at the top of the market, or they didn't invest with sketchy people with no track record.
Yeah.
Or they're sophisticated enough that they're like, yeah, sometimes you lose money, but I have more money that I need to invest. Right.
Right.
And so if you just go to them with the same thing that you were trying to do at the top of the market, where it's like, oh yeah, we're going to go and put new backsplashes in the kitchen and get $300 rent bumps. Like nobody is going to believe that story.
Right.
However, if you go to them with a real legit story, like, hey, I have a track record of turning around 50% occupied buildings, and here's another one, and this is the 25th one I've done, right? They're like, here's the money, right?
Yes.
Or if you go to them with, like, hey, we have a track record of turning around these hotels. This isn't multifamily. It's a completely different asset class. They're like, okay, here's the money. We understand the story here. So just because it's harder to raise capital doesn't mean you should be discouraged. It is not impossible to raise capital. It means you have to have a compelling story.
It's the story. Yes.
Yeah.
Exactly. At the end of the day, folks, this is part of the cycle where, again, operators win, pretenders and grifters move on. Apparently, they're going to oil wells now. There's one I haven't heard in a few years. I actually remember, it's really funny. I went to an event in 2006, back when I was like, I need to sell these houses and do something with the money. And I went to an oil and gas presentation, because that was where you could, at the time, you could 1031 out of that into that asset. I don't know if you still can, but you could then. And I was like, oh my God, this is so shady. This is not where I want to play. I'm not an oil man, but yeah, it's funny that it's back.
Listen, and it's like the depreciation thing, right? Because
yes, exactly.
Because it's oil wells, you can like depreciate, you can do bonus depreciation for the whole thing right away, and blah, blah, blah. But that was the same argument for the ATM machines, which turned out to be a giant Ponzi scheme. Right. Crazy. And a lot of people that I know got burned in that ATM stuff. And it's like, just buy everywhere, right? You gotta
buy everywhere.
Buy everywhere.
Yep. Folks, at the end of the day, one of the things I'd recommend is finding operators who did not participate in the run up because they were conservative, a la Jonathan Twombly, and others, I'm sure. But again, it is going to be fun to watch this, because this is the time you should be doing your due diligence. You should be looking at deals. They're going to likely have hair on it. This will take quarters, if not years, to play out. So happy hunting. Jonathan, where can people find you?
Well, you can always find me on LinkedIn, but you should also keep an eye on my school group. I know Michael has a great one. I have a school group as well. It's school.com/AIC for Apartment Investors Club. And big things are afoot there. So I would love to see you there as well.
There you go. Thanks, Jonathan. Have a great week.
Thank you.